Hello, everybody. This is your favorite neighborhood financial advisor, Paul Jervey. Um, Wanting to come to you today simply to give you guys the update on the economy and the stock market. As you know, in Jervey Genesis Solutions, the goal is to provide you with a more in-depth, but easily digestible form of information so that you know what's going on with the economy, you know what's happening with the stock market, and you can kind of glean from that as to why your portfolios are doing what they're doing, but also be able to make some financial decisions as well. With that being said, I want to jump in and get started. And just so for the clients, I want you guys to know that there are going to be some adjustments that Michelle and I are kind of working on behind the scenes. We've been doing a lot of projects as the practice has been growing tremendously, and it's really getting to be a little bit more than the both of us can handle. So you will be getting an email as well as another video from me, just kind of outlining what is and nothing major is changing, but you know, basically about how the team is growing, and things of that nature, and what to expect from us moving forward, which is really going to be some really great stuff. But other than that, let me kind of jump into this guide to the market for the fourth quarter. And so we're kind of projecting based on data that we've already got from this year to really look into what we can expect from the fourth quarter, and then kind of gleaning into the first couple of quarters, if not the entire year of next year. So I wanted to start with economic growth. I wanted to start there. And um, really we really had a great quarter in the third quarter. I mean, economic growth was up 3.8%. So you can kind of see the trend. You know, first quarter we didn't really do so hot. Second quarter we did incredibly well, and so the third quarter numbers will be coming out here shortly, and we're expecting those numbers to be pretty much in line with what happened in Q2. Now, even though that looks very strong, and I know a lot of you have questions as to why the stock market has been increasing the way that it has, and there's so much going on from an economical standpoint, and there's just a lot of confusion as it relates to that. So I hope that I'm able to answer a lot of those questions for you. So we're going to do that as well as go through the markets. I'm going to talk about the shutdown, and we're going to talk about alternatives again, gold, all these different things, the value of the dollar, all that. So stay tuned because we're going to hit all of those information. And you know, my goal is to try to do this in 20 minutes. Even though a lot of you have said, don't worry about it, just go. With that, so I think that moving into the fourth quarter, I think that it's going to be economic growth is going to be a lot softer. And the reason why I think that it's going to be a lot softer, just based on the data, is because as far as inventories and trades, I think that that's going to weaken the number a little bit. And I think that the economy is very resilient. And I also think that with a lot of enthusiasm surrounding AI spending, that is going to somewhat help the economy stay afloat, but there is a lot of stagnation. And I'm looking to prove my point in terms of why I believe that economic growth is going to be a little bit jittery when we get into the fourth quarter, and then, you know, getting into the first quarter. Primary reason is we have a lot of stagnation within housing. The housing industry has been very stagnant as of late. Sent you guys some emails about what's going on with the housing market. But you also have lower income and middle income consumers where they're really getting squeezed, and they're getting squeezed tighter and tighter. Government spending is actually getting squeezed as well. And really, that's more at a federal level. And we're also seeing significant layoffs within the government. And this is even before the shutdown. All right, which I'm going to kind of talk about how the shutdown may impact the markets and the economy, and that sort of thing. So it's a very mixed story when it comes to the economy. And so I think that we are going to see a slowdown. And then I think that in the fourth quarter, then I think it's going to speed up again. Then I think that it's going to slow down. Now, well, why do you say that the economy is going to slow down? So here's my theory as to why I think that things are going to happen. So number one, we've got these tariffs, right? And tariffs are increasing. Now, Consumer spending has been able to stay where it's at because the tariffs, a lot of the companies haven't pushed the full brunt of the tariff cost onto the consumer. So here's one of the main reasons why I think that this is probably going to turn economic growth negative in the fourth quarter. Number one, when you get into the fourth quarter, what generally happens? Well, you have Halloween. People are spending a lot of things for the Halloween stuff, and then you have Thanksgiving coming up, and then you have the big one, which is Christmas, right? So if I'm a business and I don't want to essentially just shock the consumer body immediately with an increase in prices, I'll most likely do it when I know gradually, when I know that they're going to be doing some spending, regardless. And this is how the consuming population spends, regardless of what it says in my bank account, because a lot of people will end up spending money to the point of their credit limit. So if from a business standpoint, it does make it a little bit easier to implement some of these new tariff costs in the fourth quarter with these big expenditures that are coming. The other piece is this: the Tax Cuts and Jobs Act. Or actually, it's I forget what the full name of it is, but I think it's the Big Beautiful Bill, OBBA, extended the 2017 Tax Cuts and Jobs Act, right? So there is a huge amount of income tax refunds that are going to take effect. And I mentioned this on my last Guides to the Market. There's a huge amount of refunds. That the average refund, well, first, before I even get into that, the primary reason why 2025 is crucial is because people haven't been able to take advantage of the fact that the 2025 rates essentially were adjusted. So the IRS themselves hasn't even adjusted the withholding schedule. So what that means is people have actually been putting more into the system than they actually needed to. So this past year, when everybody got the refund, the average household, the average, got about 3,200 in terms of a tax refund. This go around, come 2026, it's probably going to be closer to 4,000, maybe even 4,200. And so, because of that large chunk, that's almost like a little bit of a small stimulus. Because of that, what do you think is going to happen when majority of the consuming population gets some extra money? They're going to spend it. And so remember, the economy spending is what drives the economy. The economy is what drives the stock market. So if they're going to spend when they get their refund, the economy will start to move forward. So if it was a negative because of the tariff piece increase, then it'll most likely go into positive territory for Q1. And that also will allow a lot of the companies to either push more tariff costs onto the consumers without them even paying attention to it. And so then, because this is sugar that's happening, they'll run out of money and then the spending will slow down. Now, the spending will somewhat stay relatively solid to a degree because you have business spending, investment spending, spending that's happening with AI. So it'll be a gradual thing, but the consumer portion will increase, decrease, increase, decrease, and potentially stagnate or just continually slow down depending on what happens. Only time will tell with that. So with that being said, you'll start to see economic growth increase, decline, increase, decline, increase, decline. All right. So I do expect the economy to still move forward and still grow. I'm not saying that it's going to go negative to the point where we're going to now have a recession or be declared in a recession, but I do think that you should expect the economy to slow down, which means that the overall returns in the market will slow down as well. Let me get into this next big piece because this has been our AI has been a huge, we'll call it water cooler talk within really in a lot of people's conversation. What's happening with AI, and it's just I've had a lot of conversations with clients as it's how it's impacting their employment, what's going to happen with them in the future. And so I think that when it comes to AI and AI spending, one thing that I want you to understand or realize really is the massive amount of spending that is being done primarily by Google, Amazon, Meta, Microsoft, and Oracle. All right. there have been a massive amount of spending, and it's going to continue to increase. So even if you look at 2024, if you can see my cursor here, right under 24, you see where we were here, and look at where we're projected to end in 25, and then where we're going in 26, and where we're going in 27. This is a massive amount of spending. So right now this year, the total capital spending just by these five companies that JP Morgan is showing, just by these account for about 8% of the business fixed investment in the United States. All right. Now, this is just those five companies. All right. And it's up an amazing amount by a year ago. So and it's going to continue. So one thing that I need you to understand is this is not like the dot-com bubble where it's a bubble and eventually it's going to pop. No, this is altering the fundamentals or the foundation of how a lot of these companies will do business today and how they're going to do business moving forward. All right. With that, let's turn to actually, there was an interesting fact here that I thought was pretty cool in terms of businesses using AI to produce goods and services. So in 2023, you'll see it's in the dark blue. You obviously see tech is really up there, educational services, real estate, and then just where they are now in 2025 and where they expect to be in the next 6 months. So there is still a lot of growth that we can expect from AI and its overall implementation. Um, let's kind of get into the labor market really quickly. And so the main thing I wanted to talk about here is the amount of jobs are openings are starting to have declined, as you can see from our high of March of 22. All right. So now this is to me where a lot of, and I think for a lot of financial advisors and definitely a lot of economic analysts, where the government shutdown is really going to impact the market. So let me kind of jump the gun. I wasn't going to talk about this until later, but the government shutdown really isn't going to impact things from a short-term perspective. Short-term meaning like, maybe the next 30 days or something like that, but it could impact things longer term. And the reason why I say that is because there is specific data that we are supposed to get that helps the markets navigate where they're supposed to go, helps companies, boards of directors, executives teams navigate what they're supposed to do and how they're going to chart their companies through these choppy waters. So if we're not getting things like the Conference Board survey, the ISM surveys, the Challenger Christmas survey, National Federation of Independents Business survey, all these different numbers that give us an idea of what's going on, where does the market get its information if those numbers don't come in? And so as a result of that, you may start to see in the interim the market start to decline because it doesn't have any real data to sit itself on. And I pray that makes sense. All right. So the next piece that I wanted to touch on was unemployment. All right. So, and wage growth, really. And I thought that this was really interesting. And the only reason why, and I brought this up in the previous, but one of the things I want you guys to notice here is that the unemployment rate and even wage growth usually have some sharp increases, slow declines, sharp increases, slow declines, sharp increases, slow declines, very sharp, slow declines. But now, if you can really see here, especially the unemployment line, it's starting to just kind of chug along really quickly. All right. And let me make sure that I get this right because I wanted to make sure that I follow my notes here to give you the right information here. And so here we go. So one of the reasons that it's doing that right now is because even though you've got payroll and job growth is slowing down a lot, because we just kind of looked at in the previous page, what's happening with job openings and things of that nature. Because and then also we don't want to forget, I didn't really go into it too much here, but the reversal of immigration. All right. So the labor supply is contracting. It is contracting. That is what is preventing the unemployment rate from moving up. Okay. You have job growth slowing down, payroll slowing down, right? And then you have the reversal of immigration and the labor supply is contracting. So the unemployment rate can't move up, right? Now, on top of that, we've got wage growth at about 3.8, 3.9. All right. Now, this was the August number. All right. And so I think that the September number, when it does come out, is probably going to be somewhere close. But overall, there's some tightness there as well. And so because the unemployment rate isn't able to move up, you're most likely not going to see wage growth move up. Now, I also want to backtrack into why you probably won't see wage growth moving either up or down so much. And the reason why you won't necessarily see it moving up is because a lot of companies right now are trying to figure out where AI is going to be implemented. All right. Now, obviously, you're going to have some key positions, but you also have to be aware that when AI comes into play, and if it can do a lot of the things that humans can do in certain industries, that is going to save companies a lot more money. So, and from a business standpoint, do we really want to put more money into these people before we see the major impacts of what AI could do for the company and how it could increase our bottom line? You also don't want to cut wages as well, because we also know that, and major businesses know that inflation, most likely, which we're going to get into in a little bit, is probably going to start to tick higher. And so there's going to be the fact that if inflation ticks higher, which it already has, which we're going to get into next, and how is the Fed going to navigate that? Are they going to continue to drop rates, or are we going to have to increase rates to kind of stimulate the money supply? So, with that being said, let's kind of jump into inflation real quick and just take a look at what's happening. So, we're nowhere near back to where we were in June of 22. We were at 9.1%. All right. But in August, you can see that, towards the summer, we saw inflation start to tick higher to where it ended at about 2.9%. All right. Now, um, because inflation is moving up, it is moving up more so around, you'll start to see here in the orange, it's moving up in that core goods area. When the companies start to push the tariffs onto consumers, you are going to start to see inflation start to increase even more. And I am estimating that we're going to start to see that happen in the fourth quarter because we have those holidays that are coming up. And then I think that you're going to see it in the first and second quarter of next year as well, because consumers are going to have more tax refunds, as we talked about. So it is a very strong possibility that inflation is going to tick higher, and that is going to um, cause the Federal Reserve to adjust their interest rate decisions. Because as it stands right now, I don't know if the Fed, I mean, they've said that they're going to drop rates, but does the economy really need it at this point? And I think that what they want to be able to do is leave some wiggle room so that they can adjust rates higher or rates lower, to be able to stabilize certain things, right? So now, if we go to, I think it's page, let me, yeah. So page 30 here. So when it comes to the Fed and interest rates, and this is a key thing to pay attention to, the green. The market is expecting the Fed to increase rates in 2026, 27, and so on. The market is anticipating the Fed increasing rates. Now, the Fed is telling us that they're actually going to, they're estimating that they want to decrease the rates. Even their long run projection is that it gets down, the federal funds rate gets down to 3%, but the market doesn't think so. And I think that it's baking in everything that I've just shared with you about the tariffs and about all the things that we've just talked about. And so because of that, the Fed may end up having to increase rates. And so that may mean that you're going to see a lot of increased stock market volatility. All right. I didn't plan on jumping to this just yet. I can't remember what page it's on, but I think it's on page 65. But this just shows you what to expect from the stock market when the Fed cuts rates. All right. So usually after the months following the first rate cut. All right. So when we have a cut in 2024, you see that it kind of went up, dipped a little bit, and then we're in 2025 and it's starting to move higher. You'll see other years where 95 it did well, 2019 it did well. It went up in 84, then dipped down, 89, '07, and 2000 didn't really do so hot. Okay. And then you can see kind of how bonds ended up doing over there under the 10-year returns, right? Um, so, so because of this, I think that if the when generally when you cut rates, markets tend to go higher because borrowing cost is a lot cheaper. When you increase rates, markets tend to go down because borrowing cost is more expensive. So this is where we'll get into and why you've seen where we've made a lot of adjustments within the portfolios and added some nuances because right now the stock market is doing well, but based on what I've shared with you, this is where you also want to be cautious. So for those of you that have emailed me and those of you that we've had meetings and those of you that we've talked about where your portfolio is doing incredibly well right now, and the reason why I've encouraged you to stick with your current allocation as opposed to trying to add more returns into your portfolio is because the volatility is going to be coming back very, very soon. All right. And when I tell you about what's happening with the bond market, that might even shock you a little bit more. So I'm just asking that you guys allow me to continue to advise and make the adjustments necessary within the portfolio. As you know, I my recommendations are never set in stone. We do what you need to do in the at the end of the day. However, based on what I'm seeing, for a majority of you, you can't afford to have a major dip within the portfolio. So when you're younger, no problem. When you're older in that retirement time frame, which our practice average age is around 62, um, it's not necessarily the best thing to try to be adventuresome with the portfolio. All right. Happy to talk more about it when the time is right. So, with that being said, let's jump into the next page. I want to go to page 25. Let's talk about the dollar. All right. So, um, the first thing that I want to share is if you see on the right side, you'll see that chart. That chart of the US dollar goes all the way back to 1970. And a lot of things that happen in the market have happened before. This really isn't anything new, and you just have to know how to navigate certain things. And there always are some nuances and things of that nature. But one of the things that you'll see is, back here, you'll see the dollar dropped in June 1980, 30%. Then shot up 88%. Then it dropped down. Now it's down 51% in 92, and then up 52 in '02, and then it dropped in '08 when everything dropped. And since '08, really, we've been on a 56% stretch. And then here, year to date, this year, it's dropped 10%. So, what does that mean? Number one, that means that, and this is why it's good to be diversified, right? And having that 10, 15, 20% exposure to international markets, which you'll see in a moment, international investments have outperformed the United States this year. Um, and it's it's also something to pay attention to as to why the dollar is doing this, right? So, some of the reasons, and I'm going back to my notes because I don't remember this verbatim, but I had to do some research and make sure that I could gather it correctly here. Um, bum, 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 bum. Okay, so one of the reasons is that U.S. growth, number one, is slowing down for demographic reasons and other reasons. So, but the other more important reason is really at the bottom here, where you see the developed markets interest rate differentials. All right. So when you see that the difference between the U.S. and international two-year yields is starting to shrink. All right. So going forward, a lot of analysts believe that the Federal Reserve will probably attempt to cut fairly aggressively, but the ECB won't be cutting. Bank of Japan will probably be rising. The gap will most likely get closer. So there's a strong correlation with the dollar and this information. So it tends to pull the dollar down. So depending on what other countries are doing as it relates to their Federal Reserve banks, does have somewhat of an impact on us because we're all in business together. So the 10% decline that we've seen has made a big difference in relative returns as it relates to international investments. So investments that are outside of the US. The dollar, I do believe, is going to continue to fall, but it's not something to the point where we need to think about the dollar is losing its solvency because it is still the world's reserve currency. And I've shared with you, I share with a lot of you that that reserve currency most likely would not get overthrown in our lifetime. All right, so this is just a cycle, and this is why I wanted to go back to history, just to let you know it's just a cycle, and we're about due, for the dollar to start dropping a little bit based on history. And when you kind of look at the stock market's doing the same thing. It's shooting up. We're about due for a stock market drop. So let's get into the markets. As you know, I love looking at my little Skittles chart here, and all of you, with the exception of a few, are very diversified within the portfolio, meaning that you've got large cap, mid cap, small cap, internationals, some of you international small, international mid, then you've got bonds, whether it's corporate, government, or treasuries, short, intermediate, and long duration, all these different things. And then we've added gold, and now we're adding alternatives, all these different things. So when you look at year to date, you'll see that the emerging markets, which are countries that are not considered developed economies yet, have done incredibly well at 28%. The developed markets, international markets are up 25%. The US stock market is really only up 14%. An 80-20 portfolio should be somewhere around 12.9%, depending on how you're invested. And so the one thing I want to draw your attention to is cash. All right. So last year and years prior, cash was doing pretty good. Cash was at 5.3, right? 5.3 here, right? In 22, cash was okay to be in. But now, as we're starting to see, cash isn't really where you want to hold a lot of your money. So you want to really focus on getting into short-term bonds if that's where you want to hold a lot of money that's not necessarily emergencies, but you don't necessarily want to take a lot of risk. Some of you know that we've put money into the Jackson National Annuity, the RILA as it's called, so that we can take advantage of the upswings, but not have to worry about losing money in that portfolio. But the main thing here is that diversification has come back into existence. And the reason why I say that is because previously we were all looking at, I think it's on this page. Let me see. Uh, yeah. Previously, for the last couple of years, everybody's been focused on the Magnificent Seven. And the Magnificent Seven aren't really that magnificent anymore because now when you're looking at year to date, the S&P is up around 14%. If you just take out the Mag 7, it's still up 11%, right? If you look at just the Mag 7 and what it's been doing, it's only up 18%. Last year, the Mag 7 did 48%. The rest of the S&P did 14. 23, it did 76%. And the rest of the S&P did 11. So we're starting to see that a lot of the companies within the stock market are really starting to gain, which is why we've made a lot of portfolio adjustments over the year and not necessarily just following the news trend and sticking with the Magnificent Seven. So a lot of you aren't necessarily going to see those major jolts in the portfolio because either we've had those conversations where we wanted to stick more closely to that and not necessarily go with the strategy of the diversification piece. So if we have, then your portfolio is well rounded, especially if we've got more of the international investments within the portfolio. You're going to be pretty much right in line with where you should be according to your risk. Now, some other things that I want to draw your attention to is I thought that this was another good one that just shows by the decades that what companies have what are the top 10 companies. So like back in 85, these were the top 10, so IBM, Exxon, GE, General Motors, AT&T. You go into 95 and it started to switch out a little bit. You go into '05, it started to switch out even more. And then now we're looking at even in 2015, it switched out. You had Apple, Exxon, Microsoft, Berkshire Hathaway, GE, Procter and Gamble. But now you're seeing in 2025, right? You're looking at primarily technology. And if you pay close attention, these are mainly the main ones that are spending a whole lot of money in artificial intelligence. So that means that if we are overly concentrated in any of these companies, that means that when they start to decline, it moves the market. So we want to have exposure to them, but we don't want to be overly exposed to them either. Let me see, where am I going to go next? So here, international investments. This is just a history of when the international investments actually outperformed the United States, going all the way back to 1975. So you'll see here that when the purple is below the line, that means that the international markets or investments underperformed the United States. Okay, that means that the United States made more money than international investments. Only a few times in the last 30, 40 years, 50 years or so, has the international markets actually made more money. And so we're in one of these trends where we're starting to see history repeat itself. We've seen it with the dollar. Right now, we're starting to see it with international investments, and that really makes sense. Anytime the dollar starts to decline, that's when you start to see international investments pick up. Why? Because foreign economies can purchase more of our goods and services because the dollar is cheaper. Already went here, went to 65, just trying to see where I want to go next here. All right, so let's talk about alternative investments. Now, I have added gold as of late this year, really, to a lot of the portfolios. And so I want to talk a little bit about why that is. And so, and I've only added it as a small portion. And really, the main reason is because gold in itself really, it keeps pace with inflation over time. It really does somewhere between 3 and 5%. It's not something that you want to add all of your eggs to that basket. But I think that it adds a layer of diversification on top of the diversifiers, if that makes sense. So meaning we're usually when you build a portfolio, you're looking at stocks, bonds, and cash. Well, in our portfolios, we're looking at stocks, bonds, cash, alternatives, and gold is a form of alternative, right? So alternatives tend to move in the opposite direction of the market. Gold has of late, a lot of people have been funneling more money into gold for a lot of different reasons. And one of them is because of the government's, the people's lack of confidence in the credit quality of the government debt. Now, this kind of takes me into talking about bonds a little bit and why we're adding alternatives to the portfolio. If you look at the debt that we have currently in the country, and it's expected to grow at a rapid rate, and I can just kind of, let me see if I can go back real quick just to kind of show you guys our federal budget here. All right, so here's our federal budget, right? So total spending is about 7 trillion per year. All right, we're running a deficit now of about 1.8 trillion. All right, so it's about 27% of the budget. So we're borrowing that money. The federal debt is expected to continue to increase over the course of time, and it's just going to continue to get bigger and bigger and bigger. And so the reason why this is a concern is because a lot of foreign countries invest in our government treasuries, our government bonds. The concern is that these countries may end up starting to say, well, should I continue to invest in your country knowing that your debt is increasing? What's the likelihood that you guys could default on the debt and then I'm not able to get my money back? Do I want to take on that respective risk? If that becomes actual reality, now you're looking at bonds not doing what they should do when the stock market declines. We all know that stocks and bonds have that inverse relationship. All right. Stock market goes down, bonds tend to go up. The bonds absorb the shock of the stock market, right? So a 50-50 portfolio, 50% stocks, 50% bonds, if the stock market drops, say 20%, you actually shouldn't drop 10% just because you're taking on half the risk of the market. You probably will only drop about 7 or 6 because the bonds will make up some of that cushion, right? Now, if that's not the case, and we have to go back and look at, well, what are some of the things that we can do and put into the portfolio that give us a layer of protection. And that's where, in case the bonds don't move the way they're supposed to, that's where the alternative investments come in. So we've added some alternative investments in the portfolios just based on and getting into them through mutual fund investment. So a lot of you will see that there's a James Alpha strategy in some of your portfolios. Some of you have the John Hancock Asset Alternative Fund in there, and you're investing in all of these things: global real estate, transportation, infrastructure, hedge funds, absolute return hedge funds, directional hedge funds, direct lending, private lending, venture capital. All right. These things tend, as you see here, are not as correlated to the stock market. All right. And that's what we want. So if we're at a 60-60-40 portfolio, which is almost in line with the stock market, we want to get into more things that are down here. Okay. And that's where the diversification comes in. So we're diversifying the diversifiers, adding this on top of the bonds in case the bonds don't do what they're supposed to do. All right. And that kind of is where, now with the gold piece, again, we've only got a small piece in there. I plan on keeping it in there because I do expect gold to continue to increase. But again, it's not going to be an enormous amount. But anytime that we do some investing, um, I always like for you guys to remember that the stock market increases and it decreases. Sometimes you're going to see throughout the course of the year, like where these red dots are. These red dots represent where the stock market dropped during that given year. The gray bars are where the stock market ended at that year. So over the course of 45 years, you had 34 years where the stock market ended up positive. Okay, so that means that even though it dropped, and you can look at a year like here, which is like 2004, it dropped 14, but it ended 26, right? 2020, during the pandemic, we dropped 34, but we ended 16, right? So far this year, we dropped 19, but we're right at 14. So just because when the portfolio drops, that's really where the magic of having your me as your advisor kind of comes into play, of making sure that we're protecting what we've gained. So in a lot of cases, it is buy low, sell high. Sometimes it is going to be taking profit and just stuffing it into the bond portion of the portfolio to make sure, or the alternative portion to make sure that we're not going to lose what we've made. All right. It really just depends on your goals specifically and what you're looking at doing. But if you're right now, you're thinking that you want to add more returns into the portfolio, just remember this and ask yourself, if the market causes my portfolio to drop 19, 20, or 30%, because those are numbers that are very realistic moving into 26 and 27, am I going to be able to handle seeing my account drop that far? All right. Now, the last piece is that I always like to show you is just the history of the market going all the way back to 97. Whenever the market drops, it will always come back. It will, and reason, when you think of it, the reason why is because we're very much in a capitalist country. So a lot of the people that make decisions in these big companies, they don't like losing. They want to make sure that they keep going further and further and further, higher and higher and higher, making more money and more money. So therefore, if you're investing in those companies, you're going to do the same as a shareholder or an investor of that company. So when the market drops, it generally, unless it's going to be a catastrophic event like the United States defaults on its government debt. We're nowhere near there because we just increased the debt ceiling. So what we're in right now, the government shutdown, we're just in a temporary shutdown. It's not us defaulting. But if the country ever defaulted on its debt, we're talking something worse than the financial crisis of 2008. All right. So we need to keep our fingers crossed and pray that that doesn't happen. But outside of something like that, the market most likely will not drop back down past its previous major crash point. All right. So if you look here at the S&P in 2009 was only at 677 points. Then it went on a 400% stretch. You invest $100 on March 9th. That $100 turns into 200. That 200 turns into 400. That 400 turns into 800. That 800 turns into 1.6 million. All right. So that basically means it doubled 4 times. All right. Then we enter the pandemic where we drop 34%. We go down. S&P hits 2,200. Okay. So still a big jump from 600 to 22. And we shot up another 114%. 22, with the year that everything crashed, bonds and stocks alike, we dropped 25%. S&P dropped 3,500, didn't go down to 22. And now we're on this stretch where we're now seeing the markets up about an 87%. And we did have a little bit of a dip here, and then we just worked our way right back up. So I say all that to say diversification is key. Never trying to time the market is also good, but the main goal is identifying what rate of return that you need to generate in order for your family to live out their financial goals and maintain the level of wealth and prosperity that you've seen up to this point. So as always, I have no idea if I went over. I did. I went over 20. This is like 40 minutes. So I hope that this was informative for you guys. As always, please, I'm using Loom now. This is so you can definitely comment and all those other things. But let me know what you guys think of this. If it's something that we should continue to do, and if it's something that you like, share it with other individuals. Because the practice is growing. I have a hard time saying no to helping people. So you'll be getting that video soon about the new adjustments that we're making so that we can continue to serve you at a very, very high level. As always, it is an honor, and I praise God for you, and I will catch you guys down the road. Take care. Bye now.